Real estate for a guy like me is an answer to a question. The question was, what if I can't move 10 years from now? What the hell do I do now? And real estate provided the solution.
Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. Before we get started, let me mention a couple of quick things. First being, if you like what you hear, please remember to subscribe to us on iTunes. I also want to let you guys know that every week I do a short 5 to 8 minute show in addition to my normal interview shows that's called Your Driving Force Success Tips. These are some of the most valuable lessons I've learned related to business and personal success. And I'm sure my guest today will agree with me in this statement in that 80% of your success in anything is your psychology and 20% is the actual mechanics. So I hope you'll listen to these additional short clips. Also, I want to hear what you think. If you have suggestions for guests or topics you'd like, please let me know. You can email me at rod@rodkhleif.com. That's rod at RODKHLEIF as in Frank.com. Or go to lifetimecashflowpodcast.com and let us know your thoughts and suggestions there. You can also set up free 30-minute calls with me to discuss anything you'd like. I love talking to you guys and will help you in any way I can. I don't personally sell anything on this podcast, so there's no hidden agenda. Whatever you want to talk about, we'll discuss. Now, I only have time for about 2 or 3 of these calls a week, but you can also schedule them directly on my calendar, which is on lifetimecashflowpodcast.com. Well, let's get into the show. I know you're going to be inspired by the man we're interviewing today. His name is Ben Leybovich. He's a very successful real estate investor, writer, trainer, but it's his story that'll interest and inspire you. He blogs on the website justaskbenwhy.com. He's got a great course there called Cash Flow Freedom University. But I'll tell you, I think what's most interesting is how he researched different sources of passive income, and more importantly, why he did that, and then why he finally got into multifamily investing. He's a wealth of knowledge, and I could keep going on, but I think you're going to enjoy hearing it from Ben more than from me. So, Ben, welcome on the show.
It's my pleasure to be with you. Thanks.
Yeah. So please expand on what I was talking about, on your story and why you got into multifamily real estate investing.
Well, I got into multifamily because SFR doesn't work in my specific marketplace, but why I got into real estate is a function of not being, or I should say, being told that I wouldn't be able to earn a living. So I'm a classically trained violinist from childhood. And when I was in school at University of Cincinnati, College Conservatory of Music, I think it was my second year maybe of master. It was a long time ago because, 41, I'm an old dude now, right? I mean...
I got you beat.
No kidding. I mean, everything hurts. Head hurts. Everything else hurts. I don't remember when this happened. But, they told me I had multiple sclerosis. I experienced some very, very strange physiological things in my body, and one thing led to another, and it culminated in a diagnosis of MS. And they told me basically, they said, we don't understand MS all that well, and we're talking 15, 18 years ago, however long it was, but we don't really understand MS that well, but what we do know is that while it moves faster in some people, slower in others, eventually, and we can't tell you when, but eventually you won't be able to move. You won't be able to walk. We have to just stop there because we don't understand much more of what is going to happen, and we can't tell you when. So basically, it was one of those, hey, you kind of have a problem, but don't do anything stupid, and we can't tell you anything else.
Wow.
So it was an interesting time, and it led to a lot of soul searching, and obviously depression was involved and all that good stuff. But the basic reality of not being able to work, aka not being able to make money, just kind of hit me pretty hard, because just like most people, my understanding of financial success was a function at that time of, getting a good job, getting good education, being talented at something, maybe perhaps a little more than most people, getting a good job and just kind of grinding it and being comfortable, okay?
Sure. Most people feel that way.
That's where most people are. It's because that's what society is teaching us, and there's a good reason for why it's teaching us that. So everybody can't be mother bees, and we just need a lot of worker bees, and I was one of them. And I was lucky with this MS diagnosis, because if you think rationally about it, if you can't work, you can't make money. You need money. I mean, it sucks that you can't make it, but you still need it. Nothing changed. If you want to have a family, if you want to have kids, if you want to live a decent life, if you want to, I don't know what my retirement looks like, but just in case, I want to make sure I can handle it financially and things like that. So just basic rationale would, pose the question, okay, you can't work to make money, but you still need money. Therefore, what the hell are you going to do to get money, to have money, in spite of not being able to work?
Sure. So what'd you do?
Well, the formula was simple. I understood enough back in the day, and I didn't know much, but I knew that the idea of generating revenues was either a function of passive income by being a business owner and benefiting from the dividends from that business, or an investor. I mean, that's the only two things that I could see with my limited scope of vision, the only two ways to generate passive wealth and passive income. And the idea of business was a non-starter for me, because I didn't have any bright ideas. I didn't really know enough about systems. I didn't have the startup capital to rent a space, to buy, anything.
Buy an existing business. I mean,
No,
yeah, you're right. You need money. Sure.
I didn't have that, nor did I have the mental capacity at that point to analyze a bidder of an existing business. So that's, it's just kind of moot point, So if business wasn't the answer, then it has to be investing, and then any kind of paper investing at that point, any kind of insurance, anything where you trade a lump sum of money for revenue stream for the same reasons was a non-starter. I realized very quickly you could use leverage in paper, but it doesn't look anything like it looks in real estate. It's much more risky. It's much more limited in many ways, and I just didn't have the startup, the seed capital to be able to trade for revenue. And of course, revenue is what I was looking for, because I needed to put bread on the table.
So what'd you do?
I started studying real estate. I realized that in this game, first of all, I quickly understood the concept of inefficient market, which, we can, and, it's not a rule, it's a theory, right? But still, it made a lot of sense to me, inefficient or efficient market hypothesis. But this whole idea, the meeting of the minds, and how it's between two guys negotiating something, and how anything and everything goes, and how money follows ingenuity and follows knowledge and all of that kind of thing. I realized that some way, some shape, something, real estate was going to have to play a really big role in what I was doing. And there are a few instances where it was kind of a ding, ding, ding moment for me, which I don't know if we need to get into what those were. They're different for everybody, but the bottom line is that real estate really is the most efficient way to create income, to create wealth in real estate. It also hurts when you do it wrong, and it hurts very badly when you do it wrong, but that's a separate conversation. the premise of real estate being just a fantastic lever to pull is absolutely true. It really
So how'd you get started, Ben? Tell us, what'd you try first, or maybe you didn't try, maybe you went right into something.
Right, I drove for dollars and I bought a house, and the kitchen cabinets were sitting in the kitchen in the box. We could see through the window. Somebody started a rehab and ran out of money. We bought a house, and I went to a friend of mine, and I said, listen, at that point I had a line of credit against my house. But it wasn't big enough to do the deal and, to do the acquisition and the rehab. So I went to a friend of mine and I said, listen, if you give me the money, I'll give you 15% when I sell the thing. I'll finance the rehab. You finance, we'll do a note and a mortgage, and let's do it that way. Well, he ended up actually taking me out, paying me off. It ended up being a wholesale deal. It wasn't intended as a wholesale deal, but it ended up being a wholesale deal. So then after I did that, and by the way, I've never done one like that since then, just because they're hard. Everybody talks about wholesale as being like this great way to get into real estate. It's not. It's not, because to find the kind of spreads that you need and to be able to market the front end, the back end, to understand the marketing at that level, to understand construction, to be able to estimate costs and all of that. That's really hard. Good wholesalers are really, really, really a rare thing. Most of the guys running around there they're just screwballs. They don't understand, don't have a chance. But the second deal I did is I bought a house that I figured I could remodel. And the house needed like 40 windows. And Rod, you know as well as I do, $250, $300 an opening, times 40.
It adds up.
Rehab. Okay, you got yourself a rehab, and here I am, greener than green. Yesterday I was sucking on mama's titty. Today I'm doing a $40,000 rehab. Not a good idea. Just flat out, not a good idea. I did it. I lost a bunch of money. Everything I made on the first deal, on that assignment, I lost on this deal. And I sat down to think. That was one of those times where I'm not a quitter, but I don't want to stand and beat my head against the wall just because I'm committed to some kind of unrealistic idea.
It's funny. You recognize that very quickly, and I will share my pain. I've owned over 2,000 single-family houses, and as a buy and hold strategy, and it is a very, very tough way to make a living, and frankly didn't work out for me. But you also realize what a lot of people don't. You have a lot of gurus out there that are selling wholesaling as a business model, and besides being much harder than they claim, as you just suggested, which is absolutely the case, if you're doing that every January 1st, you go back to work.
Right.
You're not building an annuity. You're not building a cash flow. If something happens to you, you're injured. In your case, you get MS. What are you going to do when you can't work anymore?
Well, that's the whole thing. That's when you caught me halfway there. It's almost out of my mouth. I struggled. I had this experience. I financed myself out of trouble. My investors got paid. My investors always get paid. I may lose money, but the people that work with me always get paid. And I sat down, and this was one of those crossroads. What do I do? Where do I go from here? Because layered on the fact of understanding how incredibly difficult it is to work in real estate, to have a job in real estate, and by that I mean a flipping business.
Right. Flipping or wholesaling, right?
That's right. It's all a job. How it can work in certain markets, but it's really, really hard. Couple that, synthesize that with the fact that I have a mess, and does it really create a solution to my problem? And the answer is so blatantly no, because it doesn't produce residual income. All it does is create systems by which I am the system. If I back myself out of that system, nothing stands, not even for 10 days.
Right. And is that why you said you were lucky to get MS?
That's why I was lucky to get MS, is because I have this perspective on earned income versus passive income.
Wow.
The taxation structures that are different, the multiple revenue streams that you don't work for that create very pleasant scenarios when it comes to paying taxes and things of that nature. I mean, put all that together, at that point it was kind of innate understanding. It wasn't a literal understanding. I had to live my life to kind of arrive at certain things and underscore certain things, certain concepts in my own mind, visualize what they look like factually with numbers on paper. I just knew it was all true. I couldn't quite put my finger on it, but I knew it was all true. So that's when I went away from this notion of flipping houses for something that looks like a $20,000 profit, which, you know, you own 2,000 houses. I'm going to tell you, you will agree, $20,000 profit on paper on a flip is nothing.
It's not worth the risk.
It's
not worth the risk.
And this is your Midwest, blue-collar, Ohio, Michigan, Indiana, Kentucky.
Sure, Colorado. That's where I had my first 500.
Exactly.
And no, it's not worth the risk unless you've got a big spread. And I was not a flipper. I did a few flips, at first. I was a buy and hold guy, which was still a mistake. Single family homes are a pain in the ass.
Correct.
And had I been
the systems, right? It's so
exactly. It's all about systems. Exactly. Yeah. So you realize that multifamily. You came to that realization. So tell us what you did.
I started buying them.
Fantastic.
I mean, I started buying small multifamily, and now I'm strictly looking at very big projects. Very big, 100, 200 units, syndication type projects. I have partners. I'm as your intellectual wealth matures and grows, and as you internalize certain things, you are able to grow in terms of what you do and what you look for. But I'll tell you, I have a portfolio in Lima. Somebody called me literally. CPA called me, sent me an email yesterday about a client who's looking to liquidate. I have property in that marketplace. It's a little town. I have a 6-unit building in that town. It's about a 40-minute drive for me to take a look at it. Is it bad? No. Is it great? No. Do I want it? Nah, probably not. Why do I need more? What? Do I need more depreciation? Do I need more phantom cash flow? It's all, so you understand these things, and you start underwriting differently, and you start looking at projects differently, and you start kind of envisioning the entire process differently. So
I want to stop just for a second and come back to something you just said, which was very well articulated, by the way, about how you build your intellectual capital, which guys that are listening to this, that's what you're doing right now. And when you do that through things like podcasts, through courses like Ben's course, and you're learning, you become valuable, and you are attractive to people that want to invest and invest with you, and it's much easier to syndicate. So I just love the way you expressed that, Ben, and I wanted to add a little emphasis to that.
That's right. Well, it's totally true. I mean, you are selling every single minute of every single hour of every single day. You're selling something to somebody, and if it's not something, it's yourself. Most of the time, yourself is the thing that you are selling. And what people are looking for is, what do you know?
Right.
I mean, it would be nice to have a track record. And, over time you get there. But what do you know?
Sure. And what can you do for me? And to add to your little thing about track record, don't get discouraged by that, guys, because you can bring people onto your team that have a track record. Give them a small piece to be involved. And you can piggyback on their experience. Or give them a big piece to get started. Exactly.
What do you have to lose? You need the thing about real estate, and this is what I teach people, like my course. I have a course. You mentioned my course. The way that I did it is I recorded all of it audio, just like this, in front of a microphone. Why? Because it's not about the numbers. Real estate is about perspective. The newbies, the dummies, they go to that spreadsheet, and they start putting numbers down. The numbers represent a story of future performance of an asset based on today's available information. If you don't understand, if you don't have a sense of the dynamics that exist in the life of an asset, how are you supposed to visualize what that performance picture is going to look like and then boil it down and back out the numbers? That's what we do. That's what the experienced investors do. When I sit down to analyze a deal, I spent the morning yesterday to analyze 192 units. Okay? What I did is I went through the offering memorandum and I tried to picture what owning this building is going to look like. And then I boiled every aspect of it down in terms of numbers, and then I put the numbers into the spreadsheet, and the spreadsheet told me this is what I think the asset is worth based on what you think it's going to look like. It all starts with the picture of that performance model for the building. Unfortunately, it's not all black and white. It's not all, most of it, frankly, isn't black and white. You just have to develop a sense. You don't develop that sense until you've owned property for a considerable period of time. And if you haven't, then you need people around you who have.
Yeah, I agree. There's a lot of strength in bringing people that have done it before into your camp, involving them in your first few deals and your first few syndications if you're going after larger properties, and piggyback on that experience, that knowledge. But as important is to immerse yourself in this. Analyze deals yourself. Try to figure out, what they're doing. And, you were talking about looking at this offering memorandum. You'll get a lot of these offering memorandums that are all based on pro forma. You must see the actual numbers, because unless you know what it's actually doing today, how can you possibly project what it's going to do in the future? So, just some little things to keep in mind there. Now, I know, Ben, that you have some other things that you talk about in your blogs and some of your other materials, and I'd like to segue into this.
Sure.
You have one piece where you tell people there's 20 ways that they can buy a multifamily property for as little as $2,000, and I know my listeners would love to hear a few of those ways. Can you speak to that a little bit?
Sure. Well, everything I've ever bought, the biggest down payment I've ever made was about $5,300.
Wow.
I just in the beginning I didn't have any money to make for down payment, so it's a function of either raising capital to cover that or financing the capital to cover all that. So when you're small, that's a function of setting up an LLC, giving somebody 50% stake for providing a down payment. It's a great deal for them. If you're buying a $200,000, 6-unit building and you need 25% down, somebody can get in with $50,000, but get 50% of the upside for that deal. So if you can get in at $200,000 and you can create value to where the thing is worth $275,000, then somebody for their money is getting a great piece of the pie.
So for those of you that don't know how to raise that value like you just described, can you get in a little bit of a detail on a deal like that, what you would do to raise the value? I know the answer, but I know there are people listening that won't.
Sure. So very basic, in very basic terms. SFR market is valued via something called comparative market analysis, CMA. What the CMA does is it looks at what we call comps, comparables, and then it makes adjustments to those comparables to reflect the differences between the comparable and your subject. So a good comparable, of course, is a property that had sold, it's closed, it's done, it's in the same general location as your subject, and it's pretty evenly amenitized. But for instance, if your subject property is 3-bedroom and 1.5 bath, and the comparable you have is 3-bedroom and 2 baths, then the question you are asking is, for the fact, if, let's say, the comparable sold for $150,000, but it's got 2 full baths, whereas you have 1.5 baths, the question you're asking, Obviously, my thing is probably going to sell for a bit less than the comparable because I don't have 2 full baths. How much less? That's what you're determining. And that's a function of the marketplace.
So that's for single-family homes.
That's for single-family. How much are people willing to pay to have an extra second full bath? And
right, yeah. And it's always based on comparable sales.
Correct.
Right. So let's talk about multifamily. How is that valued?
So in terms of multifamily, the basic concept here is to understand that we're buying it because it represents a revenue stream. So you're buying a 6-plex or you're buying a 4-plex because you want to make that residual passive cash flow. After all your expenses, you get to put some money in the bank, and it's recurring in principle. So if we are buying an asset because of the cash flow, because of the income it puts in our pocket, then it's naturally reasonable that the value of this asset is somehow a function of the magnitude of income it can produce. So the basic formula is, look, if I'm willing to deploy capital, so long as I receive a 10% return on my money, then for a property that generates $10,000 a year, I should reasonably be able to spend $100,000 because $10,000 is 10% of $100,000. I'm looking for 10% return on my money. So that's the basic concept of it. Now, when we talk in this formula, in this setting, when we're talking about income, what we're talking about is NOI, net operating income. And what net operating income is what's left of your gross operating income, which is your top line. Here's your rent coming in. Here's your parking space rentals coming in. Here's your storage rentals. Here's your laundry facility. Here's your late fees. Everything, by the time you add everything together, that's your top line. Out of that, you have to pay expenses. And we call that operating costs or operating expenses. So the thing you need to remember is operating expenses do not include debt service. They don't include your mortgage or mortgages, your payments on those. And the reason we do that is because we want to compare apples to apples. So if property A generates $2,000 a month top line and costs $1,000 a month to operate, everything without mortgage, and property B also generates $2,000 a month top line, but it only costs $700 a month to operate, then obviously we know that one is better than the other. However, this could be turned upside down with financing, because all of us can qualify for different financing. Rod may go in with 20% down, and on $200,000 property, his outstanding balance on day one is going to be $160,000. I may go in for the same $200,000 property and finance at 100%. So my outstanding balance is going to be $200,000 on day one. Naturally, my debt service is more than likely going to be higher than his. However, is this a testimony to the validity of the asset? Does this say anything about the asset? No, it doesn't. It says something about me, my style of investing, what type of financing I can achieve. So if you want to go into the marketplace and you want to compare apples to apples, then what you're looking at is the NOIs of those buildings. But
right. And let me add to that. You gave two examples with an example with $2,000 a month in revenue and $1,000 in expenses. Another example with $2,000 in revenue and $700 in expenses. One of the things that sophisticated investors do when they're looking at these assets and looking at net operating income is they look for inconsistencies or red flags in both the rents. They check market rents and to see if the market rents are accurate, but they also check the expenses. And there are some, you can get a feel for where the expenses should be after you've looked at enough properties to see if there's anomalies, because both raising the rents and decreasing expenses impact net operating income. So that's important.
Right. But this gets interesting because everything is said. See, it's an inefficient market, but the thing is, it costs what it costs to run property. There's literally, if you analyze 20,000 units in different cities, you will understand you're paying virtually the same amount for rent, virtually the same amount for CapEx based on the property type, virtually the same amount for everything. So it's like, yeah, we underwrite specific assets, but we underwrite them to a model. We don't try to say, hey, I'm better than the other guy and I'm smarter than the other guy.
But I will come back to you with something. And I do want to stop you for a second because they might not know what CapEx means. CapEx is capital expenditures, and with many larger properties, the bank will require you to actually escrow,
Sure.
for example, for replacing the roof at some point, or repaving the parking lot, or putting in boilers, or things of that nature. Large expenditures. So that's CapEx. But I will say this. I've come across properties in where the expenses were inflated, and they were inflated unintentionally. They were spending too much for maintenance. They had too many people on staff.
Sure.
But I agree with what you say for sure about they're all pretty much the same if they're run properly.
Sure.
That's the only caveat I'd want to add.
Which makes analyzing things easy because you don't have to wonder how much stuff's supposed to cost. You just analyze the data, and you know how much your repair maintenance budget should be for a 150 unit that doesn't have a boiler. And then you can make adjustments for the fact that boiler is a pain in the ass, and you're going to spend your life into oblivion to manage that boiler. And God forbid it has a chiller, and God forbid it has a flat roof in the Midwest on top of it. You're never going to see the end of that. So
sure.
That's the rationale that goes into this. But this rationale comes with ownership of property. It comes with looking backwards at your numbers and understanding, seeing the patterns. And until you get there, that's where you need a partner who has been there and has come out on the other side and has more intellectual property in their head.
Right. Let's get back to the creative financing. Can you speak to that a little more?
Sure.
I know I think I've heard you in another interview talk about some of these things, and I'd love to have my listeners to hear it.
Sure. I mean, on a deal like this, I would simply find somebody to put up the down payment. I'd probably give them a mortgage and have the bank finance the rest.
Right. And which is possible to do, by the way, guys. You can't really do that with single-family homes,
No.
but with multifamily commercial lending,
Correct.
They're not opposed to a second mortgage behind their debt.
And specifically, let's not make it sound easier than it is, because it takes a real relationship with the lender. It takes a real trust. But the thing to understand is that commercial banks don't sell their notes on secondary market unless you get into really, really big mortgage-backed security type stuff, CMBS type stuff. Then it's a different game. But when you're talking a 4-plex, a 5-plex, a 6-plex, an 8-plex, a 10-plex, whatever, if you're talking that magnitude, the commercial banks, they're going to keep these things on their books as actual cash flow investments for them. And therefore, they are not subject to all the Dodd-Frank nonsense and all the rest of that consumer protection, very binding regulations that disallow for a lot of the creative things. Now, having said that, again, you're not going to walk off the street and have a banker do it for you. No, you're going to have a relationship. You're going to have some track record. You're going to have to partner up with somebody who does. If you don't, you're going to have to hustle. But if you can hustle, this kind of stuff is possible. Now, you're not going to buy an asset that's worth $200,000 and get this deal done like this, financed 100%. But if you can find an asset that you can buy for $200,000 that's worth $275,000 or $3,000, and the bank agrees with you, and they believe that you can execute, then they will let you do some creative stuff.
Right.
But it takes finding the greatest deals of everything that's out there. It just, you're not going to go open the MLS, find the first 4-plex, and expect it to be that. That's not going to happen. You're going to have to find off-market opportunities. You're going to have to find things that nobody else knows about. You're going to have to create real deals.
Right. So what you're saying is there's no get rich quick. We can't get rich overnight.
No, there's no get rich quick. No, sorry guys.
Oh, I'm really glad you brought that up, honestly.
Over your audience right now.
Right. Now, and I will tell you, don't get discouraged because there are ways to find off-market deals. You can do mailing campaigns, you can network, you can get out there and look for, properties that are run down and try to contact the owners. So, it's a hot real estate market right now. A lot of people looking for real estate, and there are still a lot of great deals. So,
because guys, a great deal is a function of somebody's circumstance. It's not a function of the market. What you are doing when you are buying is you are trying to outperform the market by finding something that doesn't conform to market's assessment of its worth. You are a value investor. You are trying to find something whereby you can walk into some value, but more importantly, create a lot of value. Okay? And that's not a function of where's the Fed rate today. It's not a function of what's the capitalization rate in the marketplace. It's a function of somebody's partnership is breaking up and they need to get out of the deal quietly and expeditiously. It's a function. Yesterday I got an email from my CPA saying that there's a client who wants to sell out. Well, I can tell you nobody else got the email. I got the email. And if somebody else will get it eventually, at least I have a first look. Yeah, the question you have to be asking yourself is, why did I get that email? Well, obviously I have a relationship with a CPA. Obviously the CPA knows I can get the deal done if I say I'm going to get it done. Obviously, right? If you don't have that, you're going to get laughed at a lot. But it doesn't mean you give up. You just accept the reality that most people are going to ridicule you. They're going to laugh at you. I remember the first time I walked into my CPA and I built this fancy spreadsheet that said if I buy a single-family house and generate $180 of cash flow and then parlay that into next, how many houses do I need to retire? Well, Rod find out that 2,000 houses doesn't do it. And that's because, and that's because I didn't have a realistic expectation of the picture. I was looking at the numbers of the spreadsheet. That's not how things roll. And so, but they didn't laugh at me. The others laughed at me, and I left. These guys didn't laugh at me. That was 10 years ago, and so now I get the emails.
Sure. And these are relationships that all of you should be setting up. Your attorney, your CPA, let them know what you're interested in, and start building those relationships. Hey Ben, can you tell us about the last deal you did? What was the last property you bought, or one of the last deals that you did? Can you describe?
The last one I bought is I call it Symphony Delta. It's a 10-unit building, and I bought it in actually a couple of years back in February 2013.
Okay. Can you give us the details?
Yeah, I can't remember how much I paid for it, but $380. So I think I paid about $37 or $38 a door.
Okay.
And this was a realtor lead, actually. It wasn't a market property. It wasn't signed on with a realtor. But the realtor happened to have a friend, and this friend wanted to get out quietly, and, I happened to be at the right place at the right time, and I got the initial information. Initially, they were really high. We sat, we met, I talked to the owner. We couldn't figure anything out, and so we parted ways, and considerable time, maybe 6 months or so, I've written about that. Maybe about 6 months ago, I get a call from this realtor saying, listen, they really need to sell. If you're ready to buy, what's your number? I gave him my number, and we met that afternoon. We had a contract. I came up just a little bit. They came down a lot, but it worked. But that was an interesting deal because it's 1980, 10-unit building, literally 10-minute drive from my house. Nice, everything fine. But it made me almost nothing in the first 11 months of ownership. I remember doing my taxes and looking at the trailing 12 and then, adding in the depreciation back in and all of the passive losses, and it looked like I made about $3,000 in that first year. And that was a function of having to take a lot of economic loss, meaning evicted a lot more people than I thought I would have to. When I did, I lost money. When I had to pay the attorney every time, I had to cover the utilities. It's not like you're going to go and sue bombs at every step of the way. You're going to spend money on attorneys, then you can never possibly recover from them. So in the first...
And fix up, obviously you had turnover costs of fixing the properties fixing it back up.
That was another big thing. I mean,
Sure.
The mistake I made on that one is that I assumed that I would be able to fund a lot of that through the cash flow. But what ended up happening is I ended up having to borrow from myself in order to put money into this building. Now, the fact that I made $3,000 in the first 11 months means the building paid me back. In the end, the building paid me back. But I certainly didn't buy it for $3,000. It was more pain in the neck than it's worth for $3,000. So that was a difficult time. I questioned myself about my decision to buy this. And, 11 months went by. The second year, which would have been 2014 that I owned it, I did much better. I still had a lot of CapEx issues, but a lot less turnover. So I think I made about $12,000 that year on the building. And then the third year, which was 2016, I made about $20,000.
Fantastic.
On that building. Now,
Fantastic.
the thing you need to know is that that's the building that I bought with $5,300 down.
Can you talk about how you made that happen?
Well, exactly how I described. I had the bank said we'll go along for 70% LTV. As long as you put 5% down, and you can go ahead and bring somebody in for 25%. So I brought in an investor to put up 25%. I gave him a promissory note with a mortgage. I did a blanket note, which included this building as well as another building that's already been stabilized. And the bank did the 70%. And as far as my 5%, it was a purchase of close to $400,000. So 5% on that would have been $20,000 down, which is fine. It would have been fine. But the way that I closed and the prorations of security deposit, not the proration, but deposit of security, transfer of security deposits, transfer of
proration for rents.
Yeah, I closed.
Right.
I specifically closed like on the 4th of the month so that I
Perfect.
would get those rents prorated. And so I ended up needing actually to bring $5,300 in cash. There were a few other items that I negotiated to be prorated.
Wow, that's a huge tip there, guys. It's always a great idea in a multifamily to close on the 2nd, 3rd, 4th of the month because you'll get credit for the whole month's rents. And you couple that, like he said, with the security deposits, it can be a significant amount of money. Now let me ask you a question. Have you increased the rents on that building?
Oh, yeah.
To how much?
Well, when I bought it, rents were about $550. I think my blended rent is about above $600 today.
Okay.
On those, I mean, they're all a little bit different, but my blended, I think, is about $600. So, it's okay. It's not.
Right.
It's not. I didn't hit anything out of the ballpark, but it's one building, one deal. I've got no money in it, and it makes $20,000. Even if it makes $10,000 or $12,000 a year of free cash flow, that's still a win. But if it's capable of making $15,000 to $20,000, I'm happy with it. Considering if you underwrite the internal rate of return, it's ridiculous because there's no money in the deal.
Right. And your $5,300 is all the money in the deal, and you've gotten that back many times.
I got it back immediately, pretty much.
Now, I want to just give the listeners a cap rate example because basically what you did is you increased your rents about $6,000 a year, and which isn't a ton, and in many situations you can increase more than that. But
sure.
that added on a 10 cap, that added $60,000 in value to that property.
That's correct.
And that's how it works. When you increase the net operating income, it immediately increases your value, and that's really on any commercial property.
But the thing of it is that it goes past that. So that at the refinance, I since refinanced. I got the private money out. So the building is financed on a 20-year commercial note, fully amortized with 5-year adjustments. There's no balloons on it anymore. And the building appraised for $450. So I paid $373.5. I think it was $373.5. The building appraised for $450. My mortgage on it right now is probably about $360. So I have $90,000 of equity, $100,000, whatever it is, that went on my balance sheet with no money out of pocket and $20,000 of cash flow in 2016 or 2015. So,
right.
Not the greatest thing, but
better than a sharp stick in the eye.
That's right. But the thing to understand also is that a lot of that cash flow came out of the passive losses. So you are only looking at increasing rents, which is increasing your top line. But in the beginning, you mentioned that what we want is the spread. So we can achieve that spread also by driving expenses down. Well, you can't really drive water down. You can't drive, garbage removal down. You can't really drive sewer down. What you can drive is how much you pay attorneys to evict. You can drive how much money you lose because the bum takes 45 days to evict and they don't pay you. And then you have to take the next 3 weeks fixing the place. And then you have to offer somebody a discount at the time of the move-in because it's the middle of the winter and you are paid for the utilities so the pipes don't freeze. So those are the type of economic losses that guys that have been in this for a while are hyper aware of, that newbies don't even consider for a split second. And those losses can add up to 5, 10, 12, 15% in the blink of an eye if you are not careful. So what I've done is I figured out how to place the type of tenant into that building whereby I significantly lowered my losses, my economic losses. So not only did I increase rents by, let's say, a value of $60 per door, but I also lowered my expenses of, let's say, by value of $20 or $30 a door. And so that spread...
So are you going to talk about how you did that, or is that a secret?
Just higher quality of tenant.
Oh, I see. So it's just the quality of the tenant. I thought maybe you had a strategy where they paid the first $50 of a maintenance call or something. But it's just a higher quality tenant. Okay.
I'm not a hard ass like that. I take care of my people. But the thing is, I get better people. I make my places nicer. I take care of them. I get nicer people. And I don't buy anything whereby I couldn't do that. That's the thing you guys need to understand. There's very little that you can do as an owner to attract a good tenant base. Your asset attracts the good tenant base. What it is, where it is, within your marketplace, is what's going to do 99% of the heavy lifting. Of course, you have to fix it up. You have to keep it clean. You have to be responsive to problems. But if it's the wrong kind of asset, there's nothing you can do. You are not going to convince good people to move into a bad asset.
Couldn't agree more. And you've got to make that determination when you pull up.
That's correct. You don't buy anything that doesn't lend itself to attracting a stable, responsible tenant base. You still have to manage them, but they're manageable. And so many people aren't manageable because they're so unstable. You can try all day long, but they're just not manageable. So that's what the repositioning process has been. Yes, a lot of the value was in increasing rents, but there's a lot of value in positioning the building in such a way the location was good enough to work with me. Otherwise, I wouldn't have bought the building. But the location was good enough, and I repositioned the building in such a way to attract the type of people that are going to save me headaches, that are going to save me management expenses, that are going to save me economic losses.
Right. But I want to circle back to one thing you mentioned on cutting expenses, and it ties right in. You mentioned water. And there is an example of how you can manage expenses with water, and that is if the building you're purchasing, the owner, previous owner, has paid the water or paid the sewer, there are ways to do bill-backs with
Sure.
the tenants, and that's a quick way to increase your NOI. It's just like raising the rents, frankly, but because it impacts the tenant, the resident, financially. But it is a way to, particularly if other properties in that marketplace require that their residents pay for their water, and you're at the
Sure.
same market rent, you can certainly do that. Do a bill back if it's not separately metered. So that's something to keep in mind.
Yeah, and that was one of the strategies here. The owner paid the water, and the water happens to be separately metered to each of the units. So the tenants now are paying for the water. They're actually, I'm keeping it in my name, but they're paying me. They are RUBS to pay me. However, I will tell you that what you mentioned is completely true and completely not true. It's true in that any kind of RUBS is driven by the marketplace. Here's what I mean. There's a concept called DTI, debt to income ratio, which essentially says if your income is XYZ, your debt can only be a certain percentage of that income. If we apply that concept of DTI to the housing expenses, then you have to say for a certain number of magnitude of income, a person can reasonably only spend a certain percentage of that income on their housing. So while you could build back the water, realizing that this adds onto how much their housing costs, what you need to be looking at is your marketplace to underwrite whether or not the amount of people, the amount of money that people who are going to be living in this building make will allow them to pay more. Because if not, you're going to have higher vacancy.
Agreed. It's not a black and white thing. If your vacancies are increasing, this could be something that impacts it. And
1% or even 1%, but specifically 2% more in vacancy is going to erase your RUBS efforts in a blink of an eye.
Right.
And that's what people don't understand. There's a synergy between all of the numbers and what we do that is difficult to understand until you've been around and you've absorbed the picture. You've internalized the dynamics of how things really work. This is a perfect example of that, Rod. It's a great thing to think, I'm going to bump everybody in a one-bedroom by 25 and a two-bedroom by 35. What you got to understand is to somebody who makes $1,800 a month take-home pay, who is paying $600 of rent already, that $3,500 makes a whole lot. I've lost tenants over $35.
Right. It happens. And that's the judgment call you have to make based on your vacancy, based on the market conditions, based on what other units are renting for, if comparable units, critical that they're comparable. So, it's a judgment call. There's no black or white answer, but it is an opportunity sometimes in these properties to increase your net operating income and shouldn't be overlooked, but handled carefully, just like any rent raise, handled carefully.
Sure.
So, do you have employees, Ben, or are you a one-man show?
Nope.
How do you operate?
I have a handyman. He's been with me for 6 years, 7 years now, something, and I just run my show. It's kind of easy to run my show because I only buy. I still have some rentals that don't agree with me because I bought them before I realized all of these things. But in the last 5 years, I haven't bought anything that is management intensive, both in terms of the physical structure and in terms of the location and who it attracts. And so because of that, I don't have typically high turnover. The units are typically not difficult to work on. I try to keep away from anything that's going to keep me occupied. So my time commitment to my portfolio is not very much. And I don't do any of the physical work myself. My handyman handles it.
Oh, that's great.
If something needs a licensed technician, then, it's a telephone call away.
Right. So, I have a lot of listeners that are aspiring to become commercial real estate investors. What's some words of wisdom you'd share with them?
Well, I think you got to start small. Again, understanding that you and I can talk until we're blue in the face, that for us it's just as easy to underwrite a fourplex as it is to underwrite a 200 unit, which it is once you know what you're looking for, what you're looking at, and what you're looking for, and what the dynamics is. Maybe it is just as easy. However, what you don't know, you don't know. And the only way to learn it is to start small, to start with a duplex, a triplex, a fourplex, and begin to understand how the property and the tenants gel together. What are the kinds of things that happen? What makes, behavior in a tenant base impact your property, and how and what you can do about it? Until you've developed this intellectual worth, I think it's hyper dangerous to get into the commercial stuff. Not to mention that financing at the commercial level is much more stringent in many ways.
Okay. So what's the best advice you've ever received regarding real estate investing?
Make sure that every deal you do is better than the deal you did before.
That's good. That's good. Continually improve.
And bigger and better, because that's how you grow. And when you reach a point where maybe a deal comes to you and it's marginal, you got to ask yourself, is it worth doing?
Right.
Because if you're just at the beginning and you just want to be, and I have to segue here, real estate investing, Rod, is a sexy red object in 2016 when we're recording this podcast. Right. Everybody either is or wants to call themselves a real estate investor. And the question is why? In life, I think we have to play to our strength. And if you are a CPA, if you are a doctor, if you are an attorney, if you have a tactical advantage in the marketplace, which allows you to be generating high income, then why are you going to buy property in the sense that Rod and I are talking about buying property and dealing with leaky toilets and dealing with hysterical tenants? You don't necessarily need that. You can gain access to real estate market via other means, via syndicating, via, whatever, REITs, whatever, okay?
Sure.
The real estate for a guy like me is an answer to a question. The question was, what if I can't move 10 years from now? What the hell do I do now? And real estate, that was my big why. And it provided the solution. It was a vessel.
Right.
Unless you have a why, because this stuff is so hard, you're going to get punched so much. You'll need to get up, so often that unless you really know what you are doing, I mean, it's not a cliche. I have a course to sell, and I hope everyone who listens to this buys it because I'm honest like this with you. But it's probably terrible sales for me to tell you guys how hard this is. This is all very hard, psychologically, emotionally, physically. This game is full contact, and it's so hard. And unless you know why you are doing it and why you're not going to give up and why you're going to be one of the guys standing 10 years from now, I would really think carefully about entering, because it stops being sexy after getting knocked down about 3 times.
And you will get bloodied and beat up. And I'm really glad you brought that up, because believe it or not, one of my driving force success tips is about the power of why. And it's a very powerful segment, and I really appreciate you bringing that up, and great pre-frame for that. Well, listen, Ben, it's been awesome. You've been a real treat and a wealth of knowledge, and I know, unfortunately, we're running out of time. But I'd like you to think about one last little bit of advice you could give to my listeners about getting into, multifamily real estate investing.
I think you need to be prospecting. You need to be looking for assets. You need to be looking for money. And when I say looking, don't look for it by going to it. Ask yourself this question: how do I position myself so that I attract both? So
love that.
I attract deals and I attract money with which to do those deals. Focus on that. It's the argument of building a pipeline versus carrying buckets. Build a pipeline. Focus on the system. Focus on what you have to do, how you have to be seen by the world out there in order so that you can attract deals and money with which to do those deals.
Fantastic advice, Ben. Ben, thank you so much. It's been a great show. I appreciate your valuable time.
Thank you so much, Rod. It's been fun.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.